All right. Excellent. Good morning. How are you?
Excellent. I just wanted to say welcome.
Thank you for having me.
What's up? What's happening up in New Jersey?
Everything is happening, man. Every day that we wake up is a new exciting day in this particular business. At this point of the cycle, so much is going on. And I'm so excited to be having this conversation with you just because I think there's a lot of opportunity. And I know sometimes it may not appear that way, but I really do believe that there's just more opportunity that we can handle and things are going great. Thank God.
Well, let me tell you that I know it's taken us a couple shots to get this interview going, but I got a group of people that are dying to hear from you.
Oh, excellent. Okay.
All
Hopefully I can add value.
all active real estate investors. All of them need a guy that knows how to fund any kind of deal.
Okay. Perfect.
So, that being said, what I want to do is just ask you a couple of questions about who you are, what you do, how you
Sure.
can be a benefit to the wholesalers that I work with, and the investor, buyer, uh, fix and flippers, or with our landlords.
Perfect.
And then at the end, what I'd like to do is actually go through the live deal that I'm doing up in Macon that you're going to help me fund with a DSCR loan.
Perfect.
Awesome. Yeah, I've got a whole bunch of people that want to actually see how you go through step by step how to fund a property that only qualifies on the income of the property, not on the personal credit worthiness of the lender.
Okay, perfect. It's one of my favorite things to do because in today's market, you're going to have to get creative. If you're not creative, you're not going to succeed, unfortunately. That's how the real estate business generally is. And then my big thing is I want to teach people how to underwrite because if I teach them how to kind of pre-screen their deals and give them my thought process, by the time they come to me, the deal should work as long as they followed some basic guidelines, so should be all right.
Exactly. And that's what we need nowadays, because as we all know, America has golden handcuffs. If you got a 3.5, 4% mortgage and you got to get a new one at 7, 8%, that's a whole different world.
Absolutely. It could still pencil because you make money in the real estate business on the buy. So if you buy it low enough, it might work. But in that example, I think it's good to kind of use some of the guidelines that we're going to go over and generally use the spreadsheets that I put together because it'll protect you from yourself in some cases. A lot of times people get emotionally invested in the real estate and that's fine, but the real estate doesn't love you back. Stick to
No.
the number. You're here to make money. Those are the kind of things I try and help people with.
Now, you and I are in total agreement on this. Is that and I advise my partners. I don't want to say students. I want to say partners. And by that, what I mean is I've been doing this since 2002. So I just like to give back and give people all the knowledge that I have in my head. But I think the thing that you and I agree on is if you don't actually own real estate, you're not qualified to give people advice on owning real estate.
Agreed.
So if you could just tell the people that the world, that is the investing world that's going to watch this video, how much real estate do you own personally?
Right now, we're just getting started, and it's not a big number in my opinion, but it's right around 300 million. And it's just different asset classes because in this particular market, for lack of more inclusionary language, I think it's Christmas time. If you're paying attention, there are lots of opportunities because people were over levered. They didn't follow some of the strategies that you and I have discussed. And when you're over levered, it seems good because you can get in for less money. But then if there's any downtick in the market, you're going to be upside down on your debt service in every single scenario. So a lot of the real estate that we were able to buy was through a distressed situation where half of my tenants decided not to pay rent or something happened that I couldn't cover because if you're levered way high, 75, 80%, then if there's any downtick in the market, you're going to be upside down immediately. And the thought process generally goes to, I got to liquidate this asset because there's no way I can maintain it. And that's our opportunity as investors, guys. So too many people are over levered. You want to try and negotiate the best possible price. And then owning the real estate, you're going to have to get creative, exactly what Mike said, because it's just, you're not going to be able to do it any other way. And the financial strategies that I put together, yes, I want to lever you high, but on the exit towards the refinance, I want you to be levered lower in the 60s, maybe 70 at the max, just because you want that 5 points of downside protection if you can afford it. The models that I put together are generally going to show you how you can, if it's a good fix and flip and if it's a good refi, it'll show you that you're getting back at least 80% of the money on the way in. Therefore, I think it's a good deal. But at the same time, you want to be able to maintain that leverage because if you're levered too high, you're going to be exactly the thing that I'm just talking about now. So it's been our opportunity, and I think it's everyone's opportunity. That's why I wanted to do this because that's the market that we're in. So many people made those kind of, I don't know, innocent mistakes or intentional mistakes, whatever you want to call it. But that's our opportunity to come in and grow our own portfolios. Everyone that I know when I talked to Michael, I said everyone that did this strategy from 2008, they're all still retired.
So that being said, you answered the question, are you qualified? Because you own $300 million worth of real estate.
We're
So
just getting started.
let's start at the beginning. Tell people, what is your name? What is your company? And what do you do?
So I'm John Cruz. I'm the managing director of Icon Realty Capital. We're here based out of New Jersey, and we have a satellite office in Florida. And we were founded originally as a real estate investment group. Our mandate from our investors was to go out there and buy condos, build multifamily buildings, do fix and flips, things like that, actually acquiring the real estate. And then we got into the lending business because around 2008, you guys saw what happened. And investors, if you ever had investor money in, they don't care. Market's good, congratulations, pay me. Market's bad, that's unfortunate, pay me anyway. So we had coupons that we had to pay, interest coupons that we had to pay, and therefore we got into the lending business, and we've been doing a combination of both ever since. And it gives us a unique perspective because a lot of times, to Michael's point, I always ask, everyone has a lender. What makes you so special? Everyone's a bridge lender. Fantastic. Ask your existing lender how much real estate they own. Most of the time, zero.
Amen to that. And I advise my partners all the time that when they're trying to make creative offers to real estate agents, ask the real estate agent, have you taken the creative financing continuing education class at the association? And 9 out of 10 of them have not.
Correct.
There is no sense in beating your head against the wall trying to explain creative financing to somebody who doesn't understand it.
Correct.
Exactly. So let me ask you, what caught your attention, and how did you get into the space of helping real estate investors fund deals?
So it's interesting because I grew up on Wall Street and I was a lender in that space, just in the business financing space. And what I was looking for was passive income. So of course you see all the seminars and things online, and real estate's a great way to do that. I chose intentionally to sit on the financing side because it's my opinion that real estate is a very good way to create that passive income as long as you know how the money works. So I wanted to get into it personally because I wanted to see how it looks for myself. But then my background always as a lender, we started our own fund, and I kind of designed our loan programs in a way where I would sign on them if I was the borrower. Because my thought process being, yes, I'm going to be a lender so I can figure out this side of the business, but ultimately we want to own the real estate ourselves, and everyone should want to do that. However, you can't do that generally unless you come from money or if you have a good financing partner who's going to be creative. So I wanted to sit in that space where I could find all the advantages for myself and then teach those advantages to other people so that we can all capitalize together.
Awesome. So when you're designing your loan programs, what's your thought process?
My thought process is with what I sign on it if I was the borrower. So I tried to design everything where it could be investor friendly because we were born as real estate investors and we transitioned into being lenders, but I never lost that side of it. I understood this is what it could look like. Here's what the borrower experience is going to feel like. And as a commercial mortgage broker, which is how I broke into this industry, I loved that my lenders would get back to me eventually with something. I just hated that they took 5 days to do simple math. So my thought process was, how do I make this more investor friendly? Can I get someone back an option to do a deal within 12 hours? That would be actionable, and would it work? Because from my thought process, it's just math. Here's the leverage constraint. Here's where we feel most comfortable. You should be able to put that in a spreadsheet within one conversation. And as long as the value comes back, okay, you should be fine. In most of the cases, it's real estate. It's not brain surgery, it's simple numbers, and does it track? And if it tracks, fantastic, according to the spreadsheet and the data that we have. And if it doesn't track, I'll encourage you to stay away, which I do more times than I'd care to admit, because I'm trying to make sure people don't hurt themselves. A lot of times they get emotionally wrapped up in a deal and it's like, this deal makes total sense. It doesn't pencil. It's off by 3 or 4 points, and those 3 or 4 points could put you out of the business. You got to be very, very careful. So my thought process is always, if we're going to do a deal together, it's kind of like we're married for 12 months potentially. So I want to make sure that this relationship is going to work out good, because I would like to see you again on the next one as often as possible.
Amen to that. And I think the majority of people that are going to watch this video, because this is August of 2023, anybody who's been in the business for less than 15 years doesn't understand what a down market looks like. And from somebody, myself, that actually lived through the last downturn, you're right. Protecting against what the property is going to be worth 3 years from now is where you need to be. Because if you're underwater now, you've got a problem. But if it pulls back, you bought it right, and now you're even, you're okay.
Correct. And then it will go back up eventually, and then that's just your upside, encouragement again. But to your point, in that example, you're able to weather the storm instead of losing the asset.
Exactly. So let me ask more specifically, because everybody that watches my videos is going to be either an investor who's beginning, an investor who's in the middle of their journey, growing their financial independence, and then there's players, the people that own several $1,000,000 worth of real estate. So
Mike
what?
Grady.
What's that?
There's the Mike Grady's. There's the top of tier.
Amen, brother. I love the roller coaster. I don't know why, but I do. What are some unique value add things that you can bring to the table as a capital partner for investors, whether they're fix and flips guys or whether they're landlords for the long haul?
I think where I make most of my opportunity is actually just in solving problems. So someone who's brand new that's watching this, the challenge you're going to run into is an experience challenge. Every single person that's going to say that you're going to try and borrow money from is going to say, have you ever done this before? And if the answer is no, they're going to kind of just drop the hammer on you. I look at it differently. My programs are inclusive of someone who has zero experience. We just lower leverage a little bit, or depending on the nature of the deal, maybe I'll partner with you to get your things off the ground because I know what it was like. I remember when I was breaking into this business and no one wanted to help me either. I remember, and I wish that someone would just give me a little bit of a lifeline, like have a little faith, man. So the way I look at it is if the real estate is sound and the numbers work out, I might be willing to partner with you directly just because I know what it was like. And if I have to help you with your first 2 or 3 deals until you can stand on your own 2 feet, then fantastic. You're going to learn my thought process, my underwriting philosophy, how I look at deals. That'll make the entire industry better because to the point that Mike was making, your lack of experience is not your fault, but who's going to teach you? We're in a market where most of the people are like, oh, if you're not qualified, you're not qualified, move on. I think that's inappropriate because then you have a whole bunch of people trying to stab each other in the back. My thought process here is if it's all of us against the market, then if we're all on the same side, we can kind of make it work. You have to be willing to put people first before profits. I've lost money where I did the right thing. I told people not to do deals that I knew were going to hurt them. And in some cases, they listened to me. In some cases, they found somebody else. And then miraculously, they didn't listen and they did the deal that I asked them not to do. They were out of the business immediately afterwards. You got to look at this long-term, not short-term. Yes, there's short-term money that you can be made here. Absolutely. But the long-term goal, to Michael's point, is financial independence. You always have to see that window and not let go of that vision because it's very easy to turn and burn a property, make 100 grand and then hurt yourself. You could win and lose at the same time in this particular business if you don't do it the right way. It's very interesting to watch.
To your point, the book I would say that changed my life significantly was Rich Dad Poor Dad by Robert Kiyosaki.
That guy's my uncle. Did you see?
I didn't think of that, but okay. But the basis of that book is the rich teach their kids how to make money work for them. And the middle class and poor don't know what to teach their kids.
Mm-hmm.
And the rich don't teach anybody else.
They sure don't.
So somebody like you is unique in that you've learned the language of the rich and you're willing to teach others.
Yeah. And it's because someone did that for me. You're talking to a guy that's not formally educated. I graduated. I barely graduated out of high school, and I think I'm 15 credits away from my associate's degree. I left college and I hit Wall Street right away. And I learned everything kind of on the streets, the organic way, I guess. But to that point, there were very few people that were willing to help me. There was a lot of people that were high powered and doing very, very well, and they always looked down their nose at me. So what I did was I ended up finding a couple that were actually successful. Because here's the tip, guys: if they're not humble and willing to help, they're not actually making it. One of the things I realized is that all the people that are flashy and the custom suits and the nice cars and all that stuff, if they're not willing to take a conversation with you, they're just a broke person at a different level.
I will
actually wealthy.
Let me just tell you that because I'm 57 years old, in my life experience, the wealthiest people I know look like they don't have 2 pennies to rub together.
Correct. And they're the nicest people on planet Earth.
And they're always willing to help you out. I mean, I'm talking about people that, own 15, 16, 17 hotels, show up for a meeting in shorts, sneakers, and a t-shirt.
Yeah. Flip-flops. Wondering, like, are you sure this guy's rich? Like, why'd you bring this guy here?
Exactly. Yeah. And you got to get over that. Rich people don't have to show. Rich people with FU money, let's put it that way, don't have to show people that they have money.
Absolutely. They just have it. And that's what I mean. Some of the guys that I hold as mentors in my life, they're 7-figure earners and they don't have to answer their phone at all. I spent a weekend with one of my seniors. His name is Vinny. He's just a guy that I look up to. He's been married for 40 years and he's been a multimillionaire basically his entire life. And I remember sitting with him for the weekend and I was like, how many phone calls are you getting? And he goes, 0. I was like, why? He goes, because once your assets are established, the money keeps coming in whether you like it or not. You don't get the rush of the phone calls anymore. And he has established leadership that kind of helps him handle everything. I was blown away by that thought process because I grew up in the era that you said where it's either you do it or it doesn't get done. But that's not the way it's supposed to be. That's how you stay busy. That's not how you stay wealthy. You want to develop systems and process and have the assets that are performing well, so that way you can have the peace of mind. It's not just about making money, it's about peace of mind. And the financial independence part, life goes like this. I woke up yesterday and I was 20. Today I'm almost 40. I don't know what happened. It goes that fast. So you don't want to miss out on stuff. And if you're going to pursue this business as a career, the purpose is to get into this particular business, acquire assets, and then disappear. It's not so that you be running your next deal until you're 75 years old. You're supposed to get to the point where you're financially independent. You can live and enjoy comfortably. That's the thought process that I have with everything that I do. So that's what I try and help people get to. Now, does everyone agree with me? No. Some people just want to make $500,000 a year and just be happy with that. Some people realize that they can live off of $300,000 a year and quiet and peaceful. It just kind of depends on what your thought process is.
And then there's the Grant Cardones in the world that have to have their own G5.
Yeah, exactly. And I'm not knocking him. It's a very nice jet. He wrote the whole thing off. It's a good strategy.
But, and again, I mean, what you just alluded to is he didn't go out and create $63 million in cash and then go spend it on a jet. The way he bought that was he had a tax liability, and to offset that tax liability, bought himself a jet. So who paid for that jet?
All of his business assets did. And that's the rich dad, poor dad philosophy. Get your assets up, let your assets pay for your toys. Part of his story I thought was interesting is he was willing to live in his car with his wife for a number of years or however long it was. I don't know if you know the exact time, but he was living in his car so that way he didn't have to go get a job, so he can maintain his entrepreneurial vision. Looked like it worked out pretty good for him.
That I did not know. But then again, every single time I talk to you, I learn something new.
Yeah. Well, he's my uncle, so I have some insider.
Uncle Grant. Yep. So, let me ask you, because, obviously, when you're financing deals, we're planning for this market to tick down for the next 3 to 4 years. Where do you see the future of the real estate business going, both short term over the next 2 or 3 years, and then, of course, long term when the market bottoms out and starts to recover?
So I think right now the opportunity is going to be, if your nose is to the grindstone, I think that there's going to be a lot of wholesale opportunities, going to be a lot of short sale opportunities. And if you have the stomach for doing that side of the business, of course, it's profitable. It does take a little bit of time to get it going. From my experience, everyone that I've seen do that strategy, it takes them probably 12 months because it takes 6 months just to negotiate with the bank. On day number 181 is where they finally crack and go, all right, you've been calling me every day for 6 months. What do you want? I'd like to negotiate about this transaction. And then they finally just give you the opportunity, because the reality is these institutional lenders, they can't afford to have a non-performing asset on their books. They want to get it off as soon as possible, but they're going to wait the 6 months as part of their guidelines. And then for whatever reason, on day number 181, that's what they turn around and they say, all right, what do you want? I'll offer you 20 cents on the dollar. Let's make it 25 and go ahead and close. Then you get the contract, then you're off to the races. So there's going to be tons of opportunities like that. I would encourage you guys to be out there just networking as often as possible, looking for the wholesalers that are dealing with the distressed assets, and just let them know that you have a capital partner behind you that you can, I just raised another 100 million for this exact type of asset class that's going to be for everyone that has the type of transactions that I'm talking about. So in the next 2 to 3 years, I think we're going to have an incredible opportunity to buy the real estate distressed, renovate it to the point where you can refinance it up to a 60 or 70 leverage and build your portfolios. Why can't you guys grab 1 3-family property a month for the next 36 months? If you do that, it'll change your entire life. And then if you lever it correctly, when it starts to go back up, it'll just appreciate, and there's going to be an opportunity there to refinance and get higher leverage, pull some more cash out of the properties and continue the process. But I think right now is that moment where in the next 36 months, you can literally build a portfolio that you can live off of for the rest of your life. So although the market looks like it's falling apart, that's where our opportunity is, guys. That's what we're looking for. When everyone else is worried, people like us should be going out there and saying, we're here to save the day. And that's effectively what we're doing. And we happen to be saving the day while we're getting wealthy. So that's my thought process on it. 36-month short term, you should be able to acquire a bunch of doors. I personally, as my own personal growth, I want to have another 1,000 doors in Jersey, and I'd like to have 1,000 doors in Florida as well, because I want to set myself up where by the time I'm 42 years old, I might not be able to do stuff like this because I want to be in a yacht with Mike. Sorry, nice. We don't have cell phone service. I can't hear you. We're in the middle of the Atlantic Ocean. I'm sorry.
That being said, do you dive at all? Are you a scuba diver?
No, I'm actually terrified of the water because I wouldn't walk around in my underwear on a safari. So I don't see the purpose of doing that kind of stuff. But if you got a spear gun, I'll come with you. We'll figure it out.
All right, baby. I'm actually leading a lobster dive on the 19th of August in West Palm.
Okay, lobsters I could do. Sharks I don't want to do so much, but lobsters I could do.
Yeah, I'm telling you what, man, it is a feast after that day.
Is it okay? Is it
But
easy to you just
I've
what do you do?
I will turn you over to my instructor, and we'll get you certified in about 3 days, fully, highly qualified, certified, and then we go diving for lobsters and have a great day.
Excellent. My wife loves lobsters, so that'll be great if I can get them for free. I'll just grab them myself.
Yeah, and yeah, forget the cell phones because we go out and you're right, there's no coverage.
Yeah. It's nothing else.
One of the things I want to talk about now, in relation to where you see the future of the real estate business is, I just published an article this morning that Moody's just downgraded a whole bunch of regional banks. And as we know, the regional banks are the ones that fund the strip malls, that fund the multifamily apartment buildings. So, like you were just saying, banks don't want to own real estate, especially the commercial real estate.
Correct.
Like, and I'm a big fan of multifamily, as are you. But something you just said to me, again, I learned something new, is these banks will take them back, but because of their federal guidelines, they got to hold them for 6 months. So you can bang your head against the wall with a realtor who's got the listing, and they're never going to move on your negotiation. But on the day 181, now they're going to sell it to you for 30 cents on the dollar.
Correct. And it's because they have all their mandates and they're publicly traded in some sense, or they have investors. The investors don't want to see a non-performing asset. It doesn't look good for them. So although they have to keep it on their books for a certain period of time because they have a fiduciary responsibility to try and get back some of that, but it becomes similar to like a credit card. When I was 16 years old, I had a $200 credit card that was now worth $600 that I owed them. He ended up selling it for 20 cents on the dollar because 20 cents, you see how you do the math. It only goes back to the original principal. As long as they didn't lose any of the original principal, they might not make as much interest, but that's okay. To keep the bank solvent, all they need to get it back is the principal. So as you're going through it, when you look at those things, what was the original loan? It was $300,000 to ex homeowner. And then over 30 years, they were going to make themselves $600,000, but they can probably let that property go for 325 as long as they get back their original principal plus just a little bit. When the note was $600,000, that's the difference. If you sit there and work on them for that 181 days, they'll make you the offer that's going to put you in a position where you can actually capitalize on the real estate because they need to get it off of their books. That's where we're coming in to save the day. And then it should make sure it's a good opportunity for us too. And that's usually how it works. And with the multifamily, as you're creating these relationships, Michael's 100% right. They're going to give you something called an REO tape. It's real estate that they own that they had to take back that they want to get off of their books. Once you have access to that and you make your splash, meaning you close your first transaction, they are going to be desperate. Hey, Mike, what else do you want to buy? We have these 42 other properties. You want to take a look at these? And then when you have an abundance of incoming opportunity, you'll learn how to cherry pick the deals that are going to be the best ones. You got to put yourself in that abundance opportunity because otherwise you're going to be, fighting pigeons for crumb on every single deal. I think this one is good, so I'm going to go for it because it's your only option. If you have a list of deals, then you could choose. This one will work out the best mathematically. This one's in a good location. This one, you know what I mean? Like you want to put yourself in that abundance opportunity. And exactly what Mike said is a great way to do it because they're going to be looking to liquidate those assets because they have to maintain their own, solvency. And that's where our opportunity is. Let's make a deal.
And with banks, when banks are getting downgraded, that is the first signal that they're going to start taking stuff back because that means that their assets are not performing.
Correct. Absolutely. And what are we going to do to save the day? Hi, it's Mike and John. We can figure it out. Show us your REO tape.
You got 200 units and we're going to buy it at 20, 30 cents on the dollar. I'll take all of them.
Absolutely. Absolutely. And
that's when we first met, I think you told me that you've got more money than deals.
Yeah, unfortunately, I guess, or fortunately, I'm not sure. But it's been my experience that there's generally two different types of people that sit in this particular business. There's guys that they're managing investments and money side, which is where I happen to be, but I don't have time to look for the deals. So then there's also guys on your side of the table that have an experience with both, but you're focusing on manufacturing the deal, not waiting for the opportunities to come to you. You're manufacturing the deal by going through the short sale process and things like that. It's a perfect marriage. We just got to figure out how we can work together symbiotically because you're doing something that I can't do. I'm doing something that you can't do. We need to work together. That's usually how it works. So if we can kind of maintain that relationship with either wholesalers or people that are on the investor side, I'm happy to be a capital partner, an advisor, because there's too much business out there to be selfish right now. There's so much out there. And then once we will learn how to capitalize it, we can take over everything. I'm totally okay with having 2,000 doors fractionalized ownership. If I'm in for 20% of 2,000 doors, I'll be happy. Everyone else can share and everything else. That's fine. But that's kind of the way I'm looking at it. I heard it recently that Millionaires are generally made in the real estate business. That's like a fact. Everyone knows this. Billionaires are made in owning a small percentage of equity in a lot of stuff. So I want to get to the point where we can get to that kind of avenue. So if we all happen to be 20% partners in 2,000 doors, are we billionaires yet? I'm not sure. We'll find out. We'll discuss it on the yacht.
And that is a real paradigm shift, I think, for a lot of people, is they think they got to do it on their own, but there's power in numbers. And being a fractional owner of a much bigger deal, I'd rather have part of something than all of nothing.
Correct. 100%.
So the next question is to that, what we're talking about is, what is the best way for the people watching this video and my partners? What's the best way for them to work with you as a lender and capital partner?
We try and keep it as simple as possible. When you get the application that Michael will share with you guys, it's literally a basic 15-question appliation. What it does is it gives me just enough basic raw data to analyze the real estate separately from you guys. And then once you start to consult with me and go through it, the same way I've done it with Michael, I'll show you this deal works because of this, this, and this. And I think it's challenging because of this, this, and this. My goal is not to show you how great of a lender I am. My goal is to teach you how to underwrite a deal properly, and properly from my opinion, right? Everyone has a little bit of a different take on it. But if I can teach you how to underwrite a deal, it'll save you a lot of time and energy, because then you don't have to go into a contract negotiation under pressure. You can know that this deal actually works as long as I get it at this level and this level, and it'll give you a lot of power, because the question always becomes, does the deal work? And if so, how much money can I bring to it? If we can do that in 5 minutes quickly together, just either in a one-on-one or even in a group setting, it'll give you so much confidence. When you walk into a listing appointment or whatever you guys are walking into, you walk into a negotiation confident that this deal will work as long as I can get it at this level, you're a different person. You're not the nervous one at the table. You're the confident one who walks in with a pile of money behind you, and you know that you can execute, because I'll teach you how to do that. So if we give you that thought process, I think the underwriting part of it will help you tremendously, because the community in general, in my opinion, doesn't do a great job of teaching each other how to get money out of lenders. It's just not something that they do. The bankers don't want to give you the secret sauce. And I don't know why, but I'm of the opinion that if I give you the underwriting cues, that way you can put together a reasonable package on the deal, and you can make sure the math makes sense, then I'll just help you execute on all of it. My whole thing is speed. I want to put out money as quickly as possible, because what I mentioned before, when you have investor money in there, John, where's my coupon? I'm like, hey guys, where's the deals? So I need you guys and you need me, but we can put it together in a way where it works for everybody.
So we've talked about a lot of theory. Now let's actually do something that's live that you and I are working on right now.
Perfect.
I've got a 3-bedroom, 1-bath, 1,500 square foot property in Macon, Georgia. And a lot of people think that, oh, I'm going to go borrow this money, I'm going to get it funded. But a lot of people don't put the time and effort into, what's my exit strategy? How do I make that mortgage payment every month?
Right.
So one of the strategies that I like is Section 8. Let the government pay you every single month.
Yeah.
So that being said, then we get into, how do we fund this deal? And we're going to do it with a DSCR, or DSCR, or is it DCSR? I can never remember.
Yeah, debt service loan. That's what I call it. A debt service loan, where it's exclusively based on the rental income, not your personal income.
Okay. This property's got a value of $100,000.
Yep.
So kind of describe how can I get into this property? What do I need to buy it at to make a cash flow?
So that's a great question, because what I do is an analysis on that debt service, particularly in my model. It has all the bells and whistles on it. And when you get the basic data points to me, I can turn this around in I don't know, a couple of minutes. So when I looked at this one for Michael, it was $100,000 on the purchase price. We're assuming that the value is exactly what the purchase price is, and it seems to be cash flowing already. So when I worked up the model, it looks like the property can easily afford to do a 75 LTV financing on it, which would mean that we're bringing 75,000. You're going to have to bring about 31,000 for yourself. And it even shows you in my model here what your monthly payment's going to be and what your net rental income is going to be. So in this particular asset, it looks like after all expenses, you're going to have a monthly roll of $600 a month, which is not a bad asset. Everything is covered, and you have $600,000 in passive income. You're walking into the property for $25,000, and the debt service there, I believe, was like 1.2. So you're totally fine, which is something that's important. I want to make sure that the debt service is at least at a 1.1, because then you have enough cash there where, again, downside protection. I can get away with doing a debt service at 1.0. I don't recommend it. I think that you're running too thin, because then in that example, if someone misses a rent payment, just coming out of your pocket. I think that it's better to maintain at least a 1.2, a 1.3 on the debt service, which I'll show you guys how to calculate in a different meeting, I guess. But that's where your protection is. If it's 1.0, then again, you're running the risk of, if someone loses their job, or if someone has a fight with their girlfriend, or something happens inside of your property that you can't control, now you're going to be paying that money out of your own pocket. Leaving yourself with at least a 1.2 debt service means that if any one of the tenants fail, you should still be able to cover the mortgage. You won't make profit that month, but you'll still be okay. And that's my thought process. You know, to Michael's point, I think like a 2-family and above is good. A 3-family is good. Anything where there's multi-tenants in there, because stuff happens. You know, recently, what came down the pipe was you guys don't have to pay rent. No, that's not a good thing. You know, we had to call everybody real quick and let them know you do have to actually pay rent. That's how it works. You know, so when things like that happen that are beyond your control, you have to be careful with that kind of stuff. That's why I think the 1.20 debt service is very, very important. And in the model that I'm sure Michael will share with you guys, it goes over, give us 5 or 6 data points. Is this a good fix and flip opportunity? Yes or no. It'll turn bright green or bright red. And please adhere to the spreadsheet so you don't get emotionally involved with the property. On the second tab, it'll show you, is it a good buy and hold? Again, bright green or bright red. It highlights the debt service component for you. And it also shows you if you're getting back at least 80% of the money from the fix and flip. Those are 2 very important things, because if you want to learn how to play the real estate game for free or as little as possible, it's a matter of putting it in and getting it back out the appropriate way. So I tried to build a model that I think works. It's one that I use personally. Michael's experienced it. So far, I've heard nothing but good feedback, thank God. And I'm sure if there was something wrong with it, he would tell me. You know, so.
Just to add to what we're talking about with the deal here is, you were right. You know, when you're talking about the debt service, what happens in case the tenant doesn't pay? And that's why I like Section 8, because the government always pays.
Yep.
And the nice thing about HUD is they're actually now paying anywhere from 10 to 15% above market.
Yes, above, absolutely.
And they're also giving what do they call it? Cost increases every year.
Yep.
So what I ended up doing is I actually spoke yesterday with the director of the Section 8 program in Macon and asked him how many outstanding vouchers were. And he said, a lot. He didn't even have a number. He just said a lot.
Yep.
And because I monitor this, I've actually seen interviews with other HUD directors where, given what's going on in our economy, they're having record numbers of people apply for HUD assistance.
Mm-hmm.
So that being said, that is one of the things that I like. A problem that I solved in going into the single family home rental is you want guaranteed money. The problem with renting to somebody is you've got to qualify them. You've got to make sure that they make the payment every month. You don't know what life changes are going to happen. Now, when you go down the road of government guaranteed money, if the government stops making the payment, we've got bigger problems as a country.
Correct. 100%.
And let me ask you, and then, the thing about, especially with HUD, is what congressman or senator is going to screw with that program? Because they're going to get voted out the next election. They're never going to touch that program. They're only going to pour money into it for forever. Right.
Absolutely. It's a great way to go about it. And I wanted to pull up the actual model so I can get you the debt service in your deal. Your deal is at 1.87, which is why I felt very, very comfortable with the debt service there, because then, you can afford to lose 2 tenants and still be okay. Right. God forbid it ever happens, but having the debt service that high, that's a great pick, the one that you picked there.
Yeah.
And then to your point also, Section 8 is a great way to do it. There's also different versions of Section 8 that we spoke about before. You'd have Section 8 where people need the actual assistant. Then there's a different type of, they call it HUD VASH, Victor, Apple, Samantha, Henry, I believe it's called. And that is actually for veterans, people that came back and they're out of the system now. And a veteran that's using that type of program is just a little bit of a different person, in my opinion, but it's the same kind of government guaranteed funding. I want 1,000 doors in New Jersey because I want to make it exclusively veterans housing. I just feel like it's a need, and these people went out there and they're giving us the opportunity to stay here and get rich by protecting us. And if I can give back in any way, that's one of the things that I want to do. It's a similar program, pays above market, just like you said. The tenant's just a little bit different, so if something happens with a veteran, they might just fix it for you as opposed to, hey, let me call the city because my light bulb's not working. It's just different angles on the same exact philosophy that Michael has. But I do believe in the government funded programs because it is guaranteed. If you're going to get paid no matter what, just make sure the property is maintained and do the right thing, and then it'll work out for you. Fantastic. No issues about hey, I lost my job, I have to pay your rent later. Okay, doesn't work like that on the HUD programs.
For me, when it comes to single family homes, I compare the strategy of buying and renting a single family home to a multifamily property. Let's just say you've got a 30-unit multifamily property. Well, let's analyze this. What happens if one person stops paying the rent in each one of those scenarios? With a single family home, now you as the owner are responsible for 100% of that mortgage. With a multifamily 30 units, one person quits paying their mortgage, 29 people are still paying their rent, which pays your mortgage.
Correct.
And that's why I like the multifamily model because of economies of scale, but I like single family with guaranteed money.
Correct.
If you don't have the guaranteed money, your risk goes way up.
Correct.
So that's how we risk manage our real estate businesses, I feel. Correct.
You always want to look for the downside of it because everything is not always awesome all the time. This is not the Lego movie. Everything is awesome. No, not in real life. What ends up happening is you have to be mindful of the things that could go wrong. And not that, I don't want to, paint the gloom and doom picture, but you still got to prepare for it. Bruce Lee's old adage, when he was training people and they were like, why are you training us how to fight in a peacetime? He goes, it's better to be a warrior in a garden than a gardener in a war. You always want to be prepared for the downside because it could happen. And if it could happen, why not be prepared for it? Otherwise, you're going to be exactly the people that we are coming in to save the day for because they didn't think about that downside protection. They thought everything was going to be up all the time. And now we're buying all their real estate.
And one of the things that I had to learn the hard way, way back in 2008, is exactly that. And while experience is the best teacher, it's also the most expensive.
Yeah. Yes. It's much cheaper to watch what everyone else did and learn from their mistakes and try not to make those same ones. That's why I love that we're talking about all the different history of stuff because you got to look back, not, 15 years, 20 years, look back historically and you'll see the cycles. They create these curves. And if you design it for yourself, whether you've been in the business long enough or you study it, looking at the history of how things worked in the past is exactly how you can give yourself a key to the future. It's unreal. And most of the time people don't look at it that way. Oh, everything is good right now. I'm going to jump in. Great. It goes in waves. Are you aware of the 10 or 15-year cycle? Are you aware of how things look? Are you aware of the way the rates have increased? All the different things. You have to kind of look back a little bit further. And then when you see it over a 20, 30, even a 50-year point of view, it's like, oh, so right now this should be happening next. And it's almost predictable in a sense.
That's exactly right. So you have been great. I mean, I think we've gone about 15 or 20 minutes here. So one last question is, do you have any final thoughts on how people can find deals and then get them to you so that you can evaluate them, so you can give them the advice on what to offer, and so we can actually close more deals? In other words, be confident because you can walk in to a negotiation knowing you can, once you get your parameters set, you can get it funded.
Absolutely. I think the first thing you should do is use some of the either the calculator that Michael can give you guys access to, or even just a quick link and get it over to us. Not because I want to, kind of walk through every single deal with you guys, but I want you guys to be prepared. I want you to kind of put together the basic data points, let the model tell you approximately what you should offer. So that way you can walk in with that confidence. As far as finding deals, you're going to have to go out there and hit the streets the same way everybody does. Look for a good pocket of wholesalers. Look for a good pocket of realtors that are dealing in distressed assets only. Look for your local regional banks the same way that Michael mentioned to you, because that's where all the opportunities are. It's my opinion that you got to kind of skip the realtors in this case, because they're going to add costs to your potential deal there. But it depends on what kind of stomach you have. The wholesale market is interesting. The short sale market is interesting because it's a different kind of conversation if you're going directly to the sponsor. If you have this to the owner, rather, that is unfortunately losing the property. If you have the stomach for it, it's a very great and profitable way to turn and manufacture the deals. And then once you have the opportunities, as long as you're getting a discounted, I think 20 to 30% is reasonable, because then it probably needs some renovation and things like that. So if you can get it at that 20 or 30% discount from as is value, and then you can add value to it by doing some renovation, you're always going to win. You're looking for stuff that's distressed, that's in pieces that you can put back together again. If you're looking for a perfect property, you're not going to make any money. You're looking for the one that's in pieces that you have to do the renovation work for, so you can kind of force the appreciation. And therefore, because you did that kind of a work, that's where you're going to earn your money. So I'm personally talking to, I'm a keynote this weekend on Sunday at this organization has 8,000 wholesalers in it. So I'm going to explain to them why they need me. And I think that's going to be a great opportunity, because then what I'm going to need more is the investor community, because if they're producing all these kind of deals, then I'm going to send an email to Mike and say, hey, these 15 deals are available in your market. Anything catch your interest? By the way, here's the financing that I would bring to it, and here's how much money you have to bring, and we kind of work on it that way. So I'm trying to kind of come full circle where, yes, we raised $100 million for this type of asset class and for these type of investments, but you want to have more deals coming in, so that way you can kind of share the wealth. So that's what I'm trying to do. I'm trying to make sure that there's an incoming flow of deals. I have the capital ready to go, so that way I can provide everything in one package to investors, and I'll help you grow your portfolios. I want to see as many people make it as possible, because then the ones that are like us, that operate with good morals and good values, we're the ones that can go out and teach, because they're not going to want to hear from you until you're already rich. Once Michael has a yacht, they're going to turn around and say, whatever you say, sir. And that's the idea. But I think it's going to be our responsibility as successful entrepreneurs in this country to show everybody this is how we did it. We did it without hurting anybody. We did it without screwing anybody, because that's kind of the challenge that you see in the business, is so many people are profit first, people second. I'd like to see a whole network of entrepreneurs that go out there and do it the right way and help people instead of just trying to make money. I want you all to be wealthy, but I want you to be able to sleep at night, if that makes sense. So those kind of things are the things that I talk to people about.
John, this has been a fantastic interview, just absolutely stuffed full of golden nuggets. I want to thank you for being on this interview. And man, I just love talking. I love getting all those pearls from you, man. It's just great.
I appreciate you having me. I'm looking forward to helping as many people as we possibly can. And for those of you who want to participate, Mike will give you access to me. And otherwise, Mike and I will get rich. Don't let us do that.
Let's do it together, bud.
Yeah. Thanks so much for having me, brother. I'm looking forward to catching up with you on this making deal. And as soon as you need something, you know where to reach me.
All right, will do. Talk soon.
Thanks so much.